The big economic news this week is that the Federal Reserve slashed the Fed's fund rate by 50 basis points. It's the first time they've cut their rate since 2020, over 4 years. The purpose of this video is to explain the difference of what the Fed's fund rate is, what determines mortgage rates, along with what does this mean for you as an owner or a borrower? Are there opportunities? Plus my summary of my analysis of the data, the comments of the Fed chairman, plus my experience, the quotes I'm receiving on our listings and properties we're selling or buying, borrowing against. Give you a synopsis of what to anticipate over the next 12 to 24 months. For starters, because you're going to hear all over the media, you can hear people talk about it on the streets because it's a big deal. The Fed's fund rate really controls the consumer spending and the interest that they pay on credit cards, HELOCs, home equity lines of credit, business lines of credit, auto loans, etc. The reason that the Federal Reserve dropping their rate by 50 basis points is a big deal for a consumer or those that have those products, for example, credit card debt, is that they're trying to promote, without printing money going back into the economy. These borrowers will now be paying less in interest, which means that they'll have more disposable income for the foreseeable future, as they've alluded to lower rates through the end of the year into next year, trying to stimulate and prop up the economy. What determines mortgage rates for your commercial property where you go to refinance are treasury bonds. Those can oftentimes act differently or move in different directions than what the Federal Reserve does, which is why it's important to know the difference. For example, in August, Fed Chairman Powell gave a speech in Jackson Hole, Wyoming, alluding to the fact that the Federal Reserve had enough data to justify reducing their Fed's fund rate at their next meeting, which was September 18th, plus into the end of the year and into the following year. At that meeting in Jackson Hole, immediately the bond market responded favorably, meaning their yields came down, which is why mortgage rates got better. But between that meeting and September 18th, from the announcement of the Fed's fund rate reduction, mortgage rates had rallied and they came down. They were hovering anywhere from 5.5% to 5.7%. Coincidentally, on the day that the Fed chairman and the Federal Open Market Committee met on September 18th to announce their rate cut of 50 basis points, treasury bonds actually deteriorated, meaning their yields went up, thus increasing mortgage rates slightly for the preceding few days into the following week. And you'd ask, well, the media is telling me, and everything that I hear on the news is that rates came down. The Fed slashed rates by 50 basis points. Why did mortgage rates slightly increase and not come down even further? The bond market and the analysts didn't like the statements from the Fed along with the data that they provided, more so the statements. For example, the Federal Reserve has a dual mandate, one to hedge and keep inflation in check, and the other to keep the economy stimulated via the labor markets. The Fed chairman said that inflation is starting to come down to their target rate, which is around 2% is where they'd like it. However, they're not there yet. However, they see a much bigger threat. He didn't use the word threat. However, he indicated that there is concern in the labor market that it is softening or cooling down. That means those are professional terms for that unemployment is increasing. Plus the statements going further that there would be another 50 basis point cut, plus into next year, up to 100 or 125 basis points cuts. That signals to the market that the Federal Reserve's data suggests that we're not having what's called this soft landing. We're going to most likely have higher unemployment quickly for longer, maybe some economic deterioration, less spending by companies. The bond market didn't take the economic news as favorable. Not only that, is they're saying if inflation is not yet in check, yet the Fed's policies to reduce interest rates, which their Fed's fund rate for consumers, is going to promote more spending into the economy, meaning more money flowing in. This will be cause inflation and be inflationary in nature, which means bond markets, mortgage rates, they put a yield to hedge against that inflation. They say, well, if inflation increases and the Fed's not doing anything to hedge against it, they're in fact promoting it, we have to provide a rate of return or a yield to hedge against that those potential inflationary actions by the Fed.